Swayam Prabha. Digital India. Educated India.
Hello everyone. So, starting with a new topic, discounted cash flow analysis in real estate, as part of the course, Real Estate Finance and Investment Strategies. In this particular lecture, we will be discussing about a technique. In last class, we started discussing with the valuation. First technique we took was comparable. Before that, we had an introduction regarding the valuation. Now, before we proceed with other two techniques, we will understand DCF so that we can use it in the subsequent lectures. So, moving on, first the learning objectives of this session. So, first we will understand the fundamental principle of DCF analysis. We will distinguish between DCF and other valuation methods, calculate present and future values of cash flows, develop comprehensive DCF models for real estate investments, analyze and interpret DCF results for investment decisions, and then we will apply DCF analysis to various real estate scenarios in India. Then coming to the table of content for this particular lecture, introduction to DCF analysis will be first, then we will talk about time value of money fundamentals which are related to this, then components of DCF analysis, developing DCF models, DCF in different real estate sectors, and advantages and limitations of this technique. So, what is DCF analysis? So, DCF, your discounted cash flow analysis, is a sophisticated valuation methodology that estimates the value of investment based on its expected future cash flow. Unlike simpler methods such as direct capitalization, DCF analysis explicitly account for the time value of money by discounting future cash flow to their present value using an appropriate discount rate. We have already understood what is the utility of time value of money in the previous lecture, where we discussed time value of money concept, and we understood that why the time value is there in money, and it is important yardstick to be considered. So, today's 100 rupees may not be of equal value after 5 years or 6 years. So, that has to be accounted, and that is where DCF comes into picture. So, the key principle underlying DCF analysis is that money available today is worth more than that the same amount in the future due to its potential earning capacity. This methodology provides a dynamic framework for valuation that can accommodate varying cash flows, different growth rates, and changing risk profile over time. DCF analysis is particularly valuable for income producing properties with projected changes in revenue or expenses, development projects with irregular cash flow patterns, properties in evolving markets with anticipated appreciation or depreciation, investments with significant anticipated capital expenditures, and portfolio analysis involving multiple properties with different risk profiles. Then let us talk about DCF versus other valuation method. Let us compare DCF analysis with other valuation method to understand when each is more appropriate. DCF analysis values property based on projected future cash flows discounted to present value. It involves multi-year projections with explicit modeling of changes and is highly complex. It is best used for properties with varying cash flow or changing market conditions. Direct capitalization value property by dividing 1 year's income by capitalization rate. It provides a single year snapshot with implicit assumption about growth and has moderate complexity. It is best used for stabilized properties in mature market. The comparable sales approach value a property based on recent sales of similar properties. It provides point in time valuation and has low to moderate complexity. It is best used for properties in active market with many comparable transactions. In India, DCF analysis is commonly applied to high value commercial assets and development projects, direct capitalization to small and mid-size income properties, and comparable sales to residential property. So, we have discussed comparable sales in the last class, where we discussed that we take appropriate comparable, compare it with our property and try to come out with the value of our property. So, that kind of process is used in comparables. But here in DCF, we will go for more detailed analysis and more complex analysis. So, coming to historical context in India. So, the application of DCF analysis to real estate investment gained prominence in India during the 1970s and 80s as computing technology made complex calculations more accessible. So, in India specifically, DCF analysis become increasingly common in post-liberalization era after 1991, particularly with the entry of multinational corporations and institutional investors who demanded more sophisticated valuation methodology. So, as the computer got advanced, we got computing power, and so because of that we could go for complex methods, and DCF, because of its complexities, was then being used in India. So, metros like Mumbai, Delhi, NCR, Bangalore and Hyderabad, institutional grade investments were being evaluated using this technique. The method is extensively used for commercial office properties in India, India's major IT hubs, REIT valuation and institutional investments. This evolution reflects the increasing sophistication of India's real estate market and the growing presence of international investors who expect rigorous financial analysis. Then we come to time value of money, core concept. We have briefly discussed this earlier. The core concept underlying DCF analysis is the time value of money, which states that money available today is worth more than the same amount in the future due to potential earning capacity. Present value represent the current worth of a future sum of money or stream of cash flows discounted at an appropriate rate. The formula is present value equals future value divided by 1 plus the discount rate raised to the power of number of periods. Future value represents the value of an asset or cash flow at a specified date in the future based on assumed growth rate. The formula is future value equals present value multiplied by 1 plus the growth rate raised to the power of number of periods. In both formulas, R represent the discount rate or growth rate per period and N represents the number of periods. So, understanding this concept is fundamental to all DCF calculations. So, that is why we are discussing this time value of money again, so that we understand that we will be using this in DCF. Then coming to compounding versus discounting. So, we have understood these concepts earlier, but we will go through that again, because both of them again are something very much useful in DCF. So, let me illustrate this practical application of time value of money through compounding and discounting examples. In the compounding example, if you invest 10 lakh rupees today at an annual interest rate of 8% compounded annually, the future value after 5 years would be 10 lakh rupees multiplied by 1.08 raised to the power of 5, right, and which equals to 10 lakh rupees. This will result into this 14 lakh 69,300 rupees. Conversely, in the discounting example, if you expect to receive 14 lakh 69,300 rupees in 5 years, then if we use the reverse formula, and then we get the present value at 8%, which is 10 lakh rupees. So, this demonstrates the mathematical relationship between the present and the future value. The idea is that how you want to find out, like whether you want to discount or whether you want to compound. So, that depends on the kind of requirement you have. So, accordingly you will use the formula of future value or present value, and then use it for your purpose. Then coming to the component of DCF analysis. So, what are the components? So, a comprehensive DCF analysis for real estate investment typically include several key components. First is the projection period, which defines the time frame over which cash flow will be explicitly forecasted. So, in Indian real estate practice, projection period typically range from 5 to 10 years for commercial property. So, commercial properties as the lease also are around that range. So, we take it around 5 to 10 years. Then for residential rentals, we take 3 to 7 years, and development timeline plus 3 to 5 years for that of stabilization for development projects which are undergoing development. So, that kind of period would be used for them. Then cash flow include the rental income, like the inflows in the cash flow will be rental income, parking, other operating income, terminal values, they will be there as part of inflows, and outflows would be the cash outflows would be acquisition cost, then routine operating expenses, property taxes, capital expenditure, brokerage and leasing commissions, major renovations or upgrade, and management fees. So, that will be your outflows. Then coming to two common methods. So, we have direct capitalization method, which is terminal value is equal to NOI in year n plus 1 divided by terminal cap rate, and Gordon growth model, which is terminal value is equal to NOI in year n plus 1 divided by discount rate minus growth rate. So, we will understand that. So, the terminal value represents the estimated value of the property at the end of the projection period, and typically account for 60 to 70% of the total present value in 5-year DCF analysis. These are two common approaches for calculating terminal value. The direct capitalization method calculates terminal value at the net operating income in year n plus 1 divided by the terminal capitalization rate. The Gordon growth model calculates the terminal value as the net operating income in year n plus 1 divided by the discount rate minus the perpetual growth rate, where NOI is the net operating income in the first year after projection period. The choice between these methods depend on the specific property characteristics and market condition. The direct capitalization method is simpler and more widely understood, while the Gordon growth model explicitly incorporates long-term growth expectations, but require careful estimation of the perpetual growth rate. Then we talk about discount rate components. The discount rate used to convert future cash flow to their present value reflect both the time value of money and the risk associated with the investment. So, in Indian context, the discount rate typically includes several components. The risk-free rate is usually based on 10-year Government of India bond yield, which is currently approximately 7%. To this base rate, we add various risk premium. These include a risk premium for real estate as an asset class, property specific risk factor, location risk premium, tenant credit risk, and liquidity premium reflecting the ease of exit from the investment. When determining discount rates for Indian real estate, we must also consider title risk, which is higher in certain markets due to land record issues, execution risk from delays in permit and approvals, market volatility reflecting cyclical patterns in different micro markets, and infrastructure development impact and policy changes affecting property values of operations. The typical range for discount rate in India: commercial real estate is 11 to 16% depending on the specific property and market characteristics. So, that is the overall components of discount rate. So, we have seen that risk free return, we are talking about a 10-year Indian bond. So, 7% something like that will be there for that. Then we will take into account different types of risk coming because of location, risk coming because of tenant credit, because we are talking about property, commercial properties here, and then liquidity premium and all that becomes the part of risk premiums. Then we go to NPV, net present value. So, NPV is equal to the sum of the present values of all future cash flows, both positive and negative. The formula is NPV equals to CF0 plus CF1 divided by 1 plus R to the first power plus CF2 divided by 1 plus R to the second power, continuing through CF and divide by 1 plus R to the nth power. The interpretation of NPV result is straightforward. A positive NPV indicates that the investment is expected to generate value and should be accepted. A negative NPV indicates that the investment destroy value and should be rejected. A zero NPV indicates that the investment exactly meets the required return with no value creation or destruction. NPV is an absolute measure expressed in rupees, making it easy to understand the magnitude of value creation or destruction. It is also additive, meaning NPV of multiple projects can be summed to evaluate portfolio performance. So, basically we can see that simple system is there if NPV is positive or if NPV is negative. So, coming to case study, then we can talk about. So, we have discussed about IRR before, but before I take up this case study, I will briefly discuss that IRR. So, internal rate of return is the discount rate at which the net present value of all the cash flow is equal to 0, right. So, we will be using that here in this particular next example which we will be taking. So, basically in other words, IRR represents the annualized effective compound return rate on the investment. To find the IRR, we solve for R in the equation. 0 equals CF0 plus CF1 divided by 1 plus R to the first power plus CF2 divided by 1 plus R to the second power, continuing through all periods. The decision rule for IRR is simple. If IRR is greater than the required return, accept the investment. If IRR is less than the required return, reject the investment. IRR calculation requires iterative solving or financial calculations. Since it cannot be solved algebraically, IRR provides a percentage return that is easily comparable across different investment opportunities. However, IRR can be misleading when comparing projects of different scales or when cash flow changes signs multiple times during the projection period. Now, talking about this case study. So, let us now apply this, the methods which we have seen. So, DCF analysis through a comprehensive case study of office building investment in Bengaluru. The property details are as follows. The location is Electronic City in Bengaluru, one of India's premium IT hub. Property is 50,000 square feet grade A office. The purchase price is 65 crores, which works out to 13,000 rupees per square feet. The current rate is 70 rupees per square foot per month. Current occupancy stands at 90%. Our projection period will be 5 years. We expect occupancy to stabilize at 95% by year 3 as the market strengthens and we improve tenant retention through better property management. So, this case study will demonstrate how to structure a complete DCF analysis using realistic assumption based on current Bengaluru office market conditions. So, the revenue projections. So, our revenue projections are based on careful analysis of Bengaluru office market trend in year 1 with 90% occupancy and 70 rupees per square feet per month rent. Annual rental income will be 3.78 crores. Then in year 2, occupancy improving to 92% and with rent increasing to 73.5%, 73.5 rupees per square feet, generating 4.07 crores in annual rental income. By year 3, occupancy reaches our target of 95% with rent at 77.18 per square feet, producing 4.41 crores annually. In year 4 and 5, occupancy remains stable at 95%, while rents continue growing to 81.04 and 84.09 rupees per square feet respectively, generating 4.63 and 4.86 crores. Our assumptions include 5% annual rent growth which is conservative based on historical Bangalore office market performance, and gradual occupancy improvement reflect active leasing effort and the market recovery. So, this is how it will be projected. Then coming to operating expenses projection. So, we have seen that we have projected revenue projections. So, similarly, we will also find out what are the operating expenses, and we will try to project that, because of course, there will be a revenue and there will be a deduction of operating cost. So, that will be done, and then we will come with a net figure. So, operating expense projections is also important. So, operating expenses must be carefully projected to ensure accurate cash flow analysis. Property tax starts at 30 lakh rupees in year 1 and increase by 5% annually, reaching 36.5 lakh rupees by year 5. Then we have a maintenance cost that is beginning at 25 lakh rupees annually and also grows at 5%, reaching 30.4 lakhs, around 30 lakhs. So, that is there. Property management fees are calculated as 5% of rental income and starting at 19 lakh rupees and growing to around 24 lakh rupees. So, total operating expenses increase from 84 lakh rupees to this 1.03 crores. So, the 5-period annual growth rate for expense reflect inflation expectation and typical cost escalation in the Indian real estate market. This conservative approach ensures we do not underestimate the impact of operating cost inflation or on investment returns. Then we go to net operating income. So, net operating income is calculated by subtracting total operating expenses from rental income for each year. So, in year 1, rental income of 3.78 crores minus operating expense of 84 lakh result in NOI of 2.94 crores. Similarly, we projected for every year, right? And this NOI progression forms the foundation for our DCF valuation, showing how effective property management and favorable market condition can drive consistent income growth over the projection period. Then we move to capital expenditure and cash flow. So, capital expenditure represent investment required to maintain and improve the property over time. We have budgeted regular maintenance capital expenditure of 10 lakh rupees annually to handle routine upkeep such as elevator maintenance, HVAC system repair and common area improvement. Additionally, we have planned a major renovation in year 3 costing 50 lakh rupees, which might include updating the lobby, upgrading the common areas or improving building systems to maintain the property grade A status. Then net cash flow calculation begins with the acquisition cost of 65 crores. So, because it is something which we are this particular thing is that we are starting with why we are starting it negative, because this is something which we are putting in, we are not getting out of this, we are actually paying this money. So, that is why it is negative. So, starting with 65 crores as negative cash flow in year 0, year 1 net cash flow is 2.84 crores calculated as NOI of 2.94 crores minus capital expenditure of 10 lakh rupees. Year 2 generates 3.08 crores in net cash flow. Year 3 produced 2.97 crores after accounting for the major renovation. Year 4 and 5 generates 3.55 and 3.73 crores respectively, before we adding the terminal value in the final year. Now, coming to terminal value calculation, very important. In past, we have done sensitivity analysis, we understand that how important this becomes. So, terminal value calculation requires estimating the property's worth at the end of 4-year projection period. Using the direct capitalization method, we project year 6 NOI by growing year 5 NOI of 3.83 crores by 5%, resulting in 4.02 crores. We then apply a terminal capitalization rate of 8%, which reflects the expected cap rate for stabilized grade A office property in Electronic City at the end of our projection period. Terminal value equals to 4.02 crores divided by 0.08 resulting in 50.23 crores. The total year 5 cash flow combines the operating cash flow of 3.73 crores plus the terminal value of 50.23 crores, totaling 53.96 crores. The terminal value then represents approximately 75% of our total investment value, which is typical for real estate DCF analysis and highlights the importance of accurate exit assumption. So, that is what we are getting at the end of this. So, then we move to present value calculations. Now, we discount all cash flows to present value using our 12% discount rate, which consists of 7% risk free, right. 7% risk free is coming from where? It is coming from the 10-year government bond which we have taken. So, that 10% is coming from there. We are taking that 7% risk free from there, plus 5% we are taking as risk premium. So, year 0 cash flow of negative 65 crores has a discount factor of 1.000, resulting in present value of negative 65 crores. Year 1 cash flow of 2.84 crores has a discount factor of 0.8929, producing present value of 2.5 crores, right. Year 2 cash flow discount to 2.46 crores using factor 0.7972. Then year 3 cash flow of 2.97 crores discount to 2.11 crore. Then year 4 cash flow result in present value of 2.26 crores. Then year 5 cash flow of 53.96 crore discounted to 30.62 crores using factor 0.5674. So, the total present value of all cash flows sums to the negative 24.02 crores, indicating that this investment destroy value at the current asking price. So, this is what we are getting, that now as per after taking into account the discounting factor, we are getting a total present value of minus 24.02 crores. So, let us move to investment analysis result. So, our DCF analysis yields important insights about this investment opportunity. The net present value is negative 24.02 crores, indicating that the property is significantly overvalued at the asking price of 65 crores. The internal rate of return is 9.15%, which falls below our required return of 12%. These metrics leads to a clear investment decision. The property is overvalued at 65 crores with a fair value of approximately 41 crores based on our analysis. Our recommendation would be to negotiate at a lower purchase price closer to the calculated fair value, or alternatively seek alternative investment opportunity that meet our return requirement. This case study demonstrates how DCF analysis provides objective, quantitative basis for investment decision and can prevent investors from overpaying for properties even in attractive market like Bengaluru's electronic city. So, we have seen step by step that how we started. We calculated first the revenue, the rent, everything. We calculated that. We calculated operating expenses. Then we moved on, and then ultimately we used discounting. And once we did that, we saw that NPV is negative, and negative like 24.02 crores, and IRR also much below the required 12%. And in that case, we concluded that this investment at the price which it is being offered is quite costly, and either we have option of negotiation or we can go for some other alternative. But this is not the right price at which we should go for it. Then we move on to the next one, DCF across property sectors. So, DCF analysis must be adapted for different property sectors due to their unique characteristics. For commercial office space, particularly in IT Hub, we typically use projection periods of 5 to 10 years with discount rates of 11 to 14%. Key factors include lease structures with 3 to 5 year term and escalation clauses, common area maintenance recovery mechanism, periodic fit out contribution for tenant improvements, and vacancy period between tenant transition. For retail, properties include shopping centers and mall projection periods extend 7 to 10 years, right, and with higher discount rate of 13 to 16%, reflecting greater operational complexity. Key factors include minimum guarantee rent versus revenue share model, festive season sales spikes, affecting percentage rent, common area maintenance recovery, and higher tenant turnover compared to office spaces. For residential development projects, projection period are based on development timeline, typically 3 to 5 years, with a discount rate of 18 to 22% due to development risk. Key consideration include construction phasing and associated cash flows, pre-launch and launch and post-launch sales velocity patterns, construction cost escalation, and RERA compliance include escrow mechanism. So, different type of properties have different projections, different discount rates, and we have seen the reasons behind it, that the complexities are different, the way these properties are operated are different. So, that is why we have different types of the projections which we are taking, the discount rates which we are taking. So, all that depends on the type of properties we are dealing with. Then we have advantage of DCF analysis. So, DCF analysis offers several significant advantages that make it to preferred valuation method for sophisticated real estate investors. First, flexibility allows DCF to accommodate irregular cash flows and varying growth rate over time, making it suitable for complex investment scenarios. So, in our example also, we saw that for Bengaluru office, we saw that different occupancy levels were taken. Of course, when we start and after a few years, tenants get confidence and these companies then move in, and the occupancy rates are differing. So, the other projections are also varying, not same at the same time. So, in these type of scenarios where there is a variation, in such type of scenarios, DCF becomes very good. So, that is there. Then second, comprehensiveness means it incorporates both the time value of money and comprehensive risk assessment through discount rate. So, it is incorporating both the time value of money. We have seen that how we use discounting in DCF. We saw in the last example that once we did discounting, then we realized that this particular property at which it is being offered is not profitable, right. So, even though in future projections it might seem that it is looking very attractive, but once we start discounting the cash flows, we start realizing what the reality is. So, the time value of money, that is a very interesting part of the DCF, and comprehensive risk assessment through the discount rate. So, another yardstick which comes into play is the risk assessment which we are doing through the discount rate, that is the extra risk apart from the 7% rate for the bond, Indian bond which we take. Apart from that, the extra discount, the rate which we are considering, that is being done on the basis of risk assessment. So, that is also being included in this process. Then third, transparency. So, this particular point basically saying that transparency ensures that all assumptions are explicitly stated, enabled through scrutiny and sensitivity analysis by investors and lenders. So everything is explicitly, clearly mentioned, what are our assumptions, and it helps us in better scrutiny of the whole process. When we are talking to any investor, when we are talking to clients, we are telling them every assumption which we have made, and accordingly what value we have decided on, what risk we are attributing, what cash flows, like how we are projecting our cash flows, how we are projecting our occupancy. So basically everything is transparent to investor, to person who wants to understand that how we have come about that particular rate. So DCF in that way is clearly explicit. And of course we also have sensitivity analysis, so that we know that a small variation can bring a lot of change. So that is why we are taking a specific rate. So we are very transparent in the process. Then fourth, the forward looking approach bases valuation on future expectation rather than solely on historical performance, making it more relevant for investment decisions. So many times we have seen that for projections, what we use is historical performance. On the basis of historical performance, we are projecting the future. That is, this is the trend line. This is, if this is being continued, if this gets continued, then this is what we are projecting, right? But in DCF, we are not going with historical accounts. We are going with future projections. So future forward looking guidances we are using in the calculation, and that is another important point about DCF analysis, that we are looking at the current things, but we are also looking at what are the future possibilities, and accordingly we are coming up with the the valuation. And then these advantages explain why we have this system. Also we can look at comparability. Comparability provides a consistent framework for evaluating different investment opportunities on equal basis. So it's not just that this system is inconsistent, it cannot be used at, basically when we are using it, we can compare different type of projects. Like we came up with that project which we discussed in Bangalore office, that it is not worthy for investment, but we can take similar type of other properties and then compare them. So this can also be very good for comparing. So this method is very fine in that way also. So these advantages explain why institutional investors, real estate investment trust, and sophisticated private investors rely heavily on DCF analysis for major real estate investment decisions. Then we also have to understand the limitation of DCF analysis. So despite its advantages, DCF analysis has important limitations that users must understand. So first, sensitivity to input means that small changes in assumption can lead to large valuation difference. So we have seen that this happening in sensitivity analysis also. We have seen a small change can lead to big change in output. So making accuracy heavily dependent on input quality. So this is a limitation, but this also tells you that how important the input quality is, that the data which you are inputting into DCF analysis, how important it is that we are taking this input. There has to be certain logic behind our inputting of the data or the assumptions which we are making, and because we understand that a small variation can lead to big change in the output. So our assumption is very important in this system. Second, projection uncertainty arises because the accuracy of DCF analysis depends entirely on the reliability of future cash flow projection, which becomes increasingly uncertain over longer time period. So we have seen in some property types we are taking more than 5 years period for our projection. Now sometimes in business, because of so many changes happening in policy level, in real estate, especially if we are talk about real estate, there are so many possibilities of changes at policy level, at central government level, at local body level, at state government level. So there are so many things which are beyond our control. Then in COVID-19 period, we saw that a new process started of work from home. So projections made just before that, they were of no use. So of course we understand that these type of events are once in a lifetime event, but if we take that as like that, even then there are lot of events which can lead to lot of uncertainty, and longer the period, more difficult it becomes to exactly pinpoint or project what exactly will happen after a particular period. But uh, still it is a reliable pattern, but we understand that with the time period, higher longer time period, it becomes a little tricky. Then third, discount rate subjectivity exists, because determining the appropriate discount rate involves significant judgment and can vary among analysts. So discount rate, what we are projecting, whether we are taking 12%, 13%, 15%, again that is something which is dependent on the analyst. So analyst. So it is not exactly same for everyone. We in the ranges which we have seen, that those ranges are also not very small, 15 to 18%, 12 to 13%, sorry, 11 to 13%. These are long ranges, long potential brackets. So you can see that the exact rate which is taken is also different for different analysts. So that is there. So determining the appropriate discount rate involves significant judgment by these analysts. Then fourth, complexity requires more sophisticated financial knowledge and modeling skills than simple valuation methods. Okay. So potentially limiting its accessibility. So the higher finance mathematics gets involved, and it is generally maybe not everyone is expert in that, not comfortable in that. So in that scenarios, many um, smaller number of people may understand how to do it, and even smaller number of people will be there to understand the maths behind it. So that is there, the accessibility, how much accessible it is to overall investor class. And then fifth, DCF modeling is time consuming, as developing comprehensive model requires significant effort, right? Because we are trying to, trying to be very transparent. We are trying to tell each and every point that how it is coming up, right? So that is there, so that it we have to be very thorough in our assumptions. We have to be very transparent about it. We have to do it all that, and it will take time. So these limitations highlight the importance of careful assumption developed, careful assumption development, sensitivity analysis, and combining DCF results with other valuation approach for comprehensive property evaluation, right? So then we move to Indian market consideration. So specifically Indian market, if we talk about, so DCF analysis in India must account for several unique regulatory and market factors. So like RERA impact on residential development cash flow through escrow requirements affect fund availability, right? Now there is this rule under RERA that we have to create a escrow account, and from that only the funds will be like used. So that creates a fund availability issue. So this has now become a part of assumptions and everything, because that is a government rule through this act. Then GST implication with the different rates for different property types affecting cash flows, income tax provisions such as section 80 of IBA benefit for affordable housing, developers and FDI regulation with exit requirements for foreign investors affecting holding period. So we have different GST for different, like we have different situations, different GST, and when we are talking about that, the implications of GST will also have to be taken into consideration. And then market specific risk factors that should be reflected in discount rate include title risk, which is higher in certain markets due to land record issues, execution risk from delays in permits, and approval that can significantly impact development timelines, market volatility with cyclical patterns varying across different micro markets, infrastructure development impact where planned projects can dramatically affect the property value, and policy changes that create risk of regulatory modification affecting property value or operations. So, these factors must be carefully incorporated into DCF model to ensure accuracy and relevance in the Indian context. So, we understand that apart from some general considerations which are made in DCF, in India specifically, we talk about real estate in terms of the RERA Act, the new GST guidelines. So, all of them impacting income tax consideration, impacting the DCF assessments of projections. So, that is there. Then there are some market specific risks which we have seen. Some situations can develop at the local level that may also impact our projections. So, for example, if we are talking about Mumbai, if we are talking about Bangalore, their own municipality rules might change. Small change can be can also impact our overall assessment of projection. So, there are so many things which can impact at the local level also. So, these are your Indian market considerations. Then we move to digital tools for DCF analysis. So, we have seen that DCF analysis is time consuming, it has lot of assumptions to be made, it has lot of mathematics involved, and step by step everything has to be transparent. So, there are lot of digital tools which can be used for DCF analysis. So, let us see them. So, several digital tools are available ranging from free basic tools to sophisticated professional softwares. So, free tools include Microsoft Excel, which remains the most widely used tool for DCF modeling with built-in NPV, IRR, XIRR functions that simplify calculations. We have several free real estate DCF templates that are available online from sites like Wall Street Mojo and Analyst Prep. So, there are multiple of them, but I am just giving you two names. Then Google Sheet provides a free alternative to Excel with some similar functionality, and real estate financing modeling add-on are available. Then we have Property Metrics Lite offers basic commercial real estate analysis with limited feature in the free version. And then professional paid tools include Argus Enterprise, which we had discussed earlier also, industry standard software for commercial real estate valuation used by major real estate firms globally. Then Estate Masters specializes in development, feasibility and investment analysis with comprehensive cash flow modeling capabilities. Property Metric Pro provides a user-friendly web-based platform for commercial property analysis. Then a good recommendation to start with Excel template, that will be there to understand the underlying mechanism. That is the most easiest path to understand the whole process, and then advance to specialized software as your modeling become more sophisticated. Then talking about the best practices for DCF modeling. So, following best practices ensures your DCF models are reliable and defensible. First, use conservative assumptions rather than optimistic projections for growth and occupancy rates, as it is better to be pleasantly surprised than disappointed. We have discussed this I think from the point when we started discussing time value of money, that the assumptions which we are making should be conservative in nature, so that the surprise if we are getting is on the pleasant side, instead of painting a very rosy picture. Our assumption should be rooted and should be realistic, so that they are very much close to reality, and if we are in the in a way that the output is better than what we have expected. And then we have sensitivity analysis. So, sensitivity analysis by testing key variables with plus or minus 10% variations to understand how change affect your result. So, when we are doing this analysis, we should also do the sensitivity analysis by creating an envelope of plus and minus percentages, so that we know that what variations can lead to. Third, base assumption or thorough market research using comparable market data, consulting property managers and engaging leasing agents for current market insight. So, this market research should be very well rooted. It should be done with thorough understanding of what are the right comparables, what are the right people to talk to. So, through them you can understand if your understanding of the whole market situation um, is right, is currently what it is prevailing in the market. So, that we get through market research. And fourth is seeking professional input from experienced practitioners who understand local market condition and typical operating parameters. So, of course, experience is useful everywhere, and experienced professional analyst, people who have thorough understanding of a local real estate market, they can give you some specific inputs which are not easily available online, or which are not there in maths, but through their experience they can tell you what is the possibility. So, that can be something. And then uh, we have regular updates so regularly updating model as market condition changes, since DCF model reflect assumption at a point in time and should be revised as new information becomes available. So, we should not be very strict about our assumptions. We should be flexible enough, because if any update comes in, we should update our assumptions accordingly. Then document all the assumptions and sources to ensure transparency and enable others to understand and validate your analysis. So, whatever analysis we are doing, we should keep proper documentation of all the assumptions which we have made, and the sources of for those assumptions, because that is also important, how reliable those sources are. So, if somebody else wants to check or validate our results, they can do that easily. So, these practices enhance the credibility and usefulness of our DCF analysis. Then there are certain mistakes we should try to avoid. So, several common mistakes can significantly undermine the accuracy of DCF analysis. So, over optimistic projection represent the most frequent error. We have discussed this many times. Again, remember this is a big error which can happen, big mistake. So, over optimistic projection should be avoided, where analysts use unrealistic rental growth assumptions that exceed historical market performance without justification. Ignoring market cycle is another critical mistake, where models fail to account for cyclical downturn that inevitably occurs in real estate market. So, we have talked about this earlier. Taking projections at the top of boom, or when there is a bubble in market, at the top of that you are making higher and higher projections, and at the most worst situation or most difficult times of bear market, we are taking the most pessimistic assumptions. Both can lead to big wrong outputs. So, we have to check what is the current state of the market cycle. With experience we can do that. Then inappropriate discount rates, using generic rates without property specific adjustments, that we have discussed earlier, that should not be there. Discount rate should be appropriate. Whatever ranges we are doing, should do it with proper understanding. Then terminal value error includes inconsistent growth assumption, where the terminal growth rate exceeds long term economic growth or market fundamental. Then neglecting capital expenditure leads to overvaluation, when analysts underestimate ongoing maintenance requirement and major renovation needs. Using outdated comparable information can skew assumptions when market conditions have changed significantly since the data was collected. Avoiding these mistakes require disciplined analysis, conservative assumptions and regular validation against market evidence. Then coming to conclusion, key takeaways. TCF provides comprehensive framework considering time value of money, particularly valuable for properties with varying cash flow. What are the key components? Cash flow projections, terminal value and discount rate. More complex but offer greater flexibility than other methods. Must account for Indian regulatory and market factors. Sensitivity analysis essential for understanding risk. Different property types require different approaches. So that we should remember. Then question which is there for the further consideration, you should think about it. How might current interest rate environment affect discount rates? What are the key risks in projecting cash flow for different property types? And how can DCF analysis be adapted for special purpose properties? There are some specific unique properties. What can be DCF analysis for them? Think about all these questions. With that, thank you so much.